Hi, everyone. Welcome to the 130th episode of the Timing Research Show for March 20th, 2017. I'm the creator of Timing Research. Today, we will be talking about the 182nd weekly report. If you haven't had a chance to take a look at this yet, you can go to TimingResearch.com/reports and download this or any of the past reports there. I'm Jenkins back today to host, so I'm going to go ahead and turn it over to him.
All right. Well, thanks, David. Thanks for setting it up. Thanks for inviting me back. I always enjoy this show. It's a great forum, and you are able to line up some really smart folks who know what's going on. So I got a couple, I think at least one person I haven't even been on the show with before, so I'm really looking forward to hearing what he and everybody has to say. So why don't we start by just having each of the panelists introduce themselves and just tell us a little bit about your site, a little bit about yourself, real quick intro. So we'll kick that off with you, Larry.
Well, thank you very much for having me here today again. So I do enjoy the show quite a bit. My site is powercycletrading.com, and it's a trading educational service. So kind of focus and specialize on looking at various price action movement and then trading that with options. So been in the trading business for over 30 years. Ran a large international trading group for an oil company, for major oil trading company for 10 years. So a lot of experience in commodities and just trading in general. And so been trading options since back in the late 80s. We started trading options on crude oil. And so that's kind of been my passion ever since. So that's a little background on myself, and specialize and try to pick good price action for direction and then combine that with options to manage the risk. So that's what we're all about.
All right, outstanding. I look forward to hearing what you have to say about the market, and particularly when you start talking about trades. If you're focused on oil, that's a wild ride, man. There's no boring days on oil.
That's for sure.
Yeah. So I guess Neil's still trying to log in. So John, if you'd tell us about yourself, your site, what you do, it'd be great.
Well, first of all, my hat's off to Larry. Anybody who's still standing after trading oil options for 30 years, hats off to them. One of the great revelations I learned early on in the oil business, and I've been at it for 50 years, is that oil companies never know what the price of oil is going to do. Second, any company takes a view they're out of business within 10 years. So with that said, I am John Thomas from the Mad Hedge Fund Trader. We have a daily blog and research trade alert service. You can find us at madhedgefundtrader.com. We're averaging about 38% a year right now, and so far in 2017, we're up 23% on the year, and that is long, short, global, macro. We trade stocks, bonds, commodities, real estate, precious metals, and yes, even oil.
All right, John, good to be back on with you again. So I am Dean Jenkins, founder of followmetrades.com. So I'm a trader first. I trade my own account, and I run a stock advisory service. So when I'm taking trades, I give alerts and people can follow along. I also do some education and run a hour and a half live trading room in the mornings, Monday through Thursday. So trades.com, and I enjoy talking to traders like the ones on the line here or in the trading room. I like trading. I like talking about the markets and looking at charts. Good stuff. All right, well, let's get into the meat of the show here. David publishes his Timing Research Crowd Forecast prediction, and for this week, it's a 64% chance higher on the S&P from Monday's open till Friday's close. And he had some interesting notes in the report this week that all time since he started doing this is correct just over half the time, 51.4. His 1 year average is 54.9. And look at this, the 12-week average for being correct, the last 12 weeks, 81.8% correct. I think most traders would be absolutely thrilled to have an 81% correct rate. So the sentiment report lately has been doing really well. And this week, predicting a 64% chance higher in the market. So I'm going to ask each of the panelists to say what direction you think the S&P 500 is going to go from Monday's open to Friday's close, up or down, and the confidence on your answer, just in terms of a percentage. And don't give your reasons yet, because that's the next question. We don't want to undermine that session. We don't want to give away the surprise. So just each of you for this week, and what's your confidence level on that? And we'll just start with you again, Larry. Where are we going?
Slightly higher for the week, and give that about a 65% probability.
So Larry's up slightly, 65%. All right, John, we're gonna be on the same page here. We're gonna have a little.
No, I'm gonna whip out here and say unchanged on the week. And,
flat.
50% confidence level. I think it's likely we'll be either within 1% higher or lower than we are right now, and that's not enough for most people to trade around. You're watching the VIX at a multi-year low. Ranges are narrowing. Volume is falling. It's not a good setup for anything. So we're shorting out of the money calls and puts. We're betting that the market moves less than 2% up or down in the next week or two.
Okay, fair
Longer
enough.
term we go up, but for the short term, that's the call.
Fair enough. Fair enough. Flat at a 50%. So that's like a non-opinion, right?
And that's what the market's telling you. It's with these flatline moves. We may get a rally after Comey's testimony, but not a big one. You're looking for double-digit points maybe.
All right. So I'm thinking lower on the market. So I'm down. I'm not 100% confident on that. So I'd give that. I like 65% that Larry was using. So I'm at 65% down by the end of the week. So it's pretty good. We got
one higher, one lower, one unched with a 65% conviction. It's a perfect.
Right.
It all adds up to a perfect zero.
Yeah, exactly.
All right. So it's a good time, all traders. Go ahead and shut down your computers. Get your golf clubs out. Walk the dog. Let's take the week off, right? Nothing.
Oh no, you can make money on nothing. You can make big money on nothing. It can be done.
I'm a trader, so I don't like nothing. All right, let's move to
most people do nothing.
Let's go ahead and move in. Why? Let's get into the reasons for what we think about the market here. And this is a point where you could show a chart or any kind of data on your screen to back it up. But go ahead and we'll start again with Larry. And Larry,
Okay.
Go a little deeper. Tell us why you think it's going up, what your confidence level is, and again, you can share a chart or any information you'd like to.
Well, here are my charts. If you can see these charts, I've got 4 charts. You'll see all the 4 major indexes. You'll see the NASDAQ 100 here on the far left, the S&P, the Russell, and the Dow. Now, the reason, I'm kind of more in line with John Thompson, actually, just kind of a little sideways. You can see here the S&P, but the NASDAQ is still, a little bit more supportive. And the other thing that I like is that some of the big NASDAQ stocks, so be it the FANG top stocks like Amazon potentially has a potential to break out to make new highs. NVIDIA is starting to look good. So some of the big key NASDAQ stocks are looking okay. So I think that could keep the market stable to maybe a little bit higher, but not a whole lot. You can see what we call price momentum divergence. My momentum indicators are down, price is sideways. So, it's a churning type market, but, with the NASDAQ, I think we could inch up a little bit higher. So that's why I'm saying higher. And the other thing too, that I'm throwing into the old equation is that the seasonality, you tend to get a little bit of a push up for the NASDAQ and also the Dow as we get in towards the end of the March. So that's kind of going in towards the end of this week. So maybe we'll see something pushing there. But overall, I think the main thing that could push it a little bit higher would be some of these NASDAQ stocks. Other than that, I kind of see it churn sideways. So that's kind of my take on why it might go a little bit higher into the end of the week.
Okay, very good. That's a serious chart looking setup there on your charts, man. That's a lot of information.
You see those in the oil industry all the time, by the way.
All right. All right. So, yeah, thanks, Larry. Very good explanation. John, what's your reasons for flat with a 50% confidence? And again, you can share a chart or any information you like while you give that.
My reasons are basically fundamental. I think the market has taken prices as high as it will go based on the promise of deregulation, tax cuts, and infrastructure build out. To get any higher, we need to see concrete action out of Washington. That action may be anywhere from 3 months to 12 months to never. So, people just don't want to chase this market based with the evidence they have in hand. They need to see more. It could be a long wait to get more. In the meantime, the seasonals are slowly turning against the market. We're coming up to a sell in May period and a seasonal 6 months of the year where markets are traditionally weak. But supporting the market underneath is the fact that most big institutions are still underweight equities and have been underweight for several years. So they haven't had a chance to make their reallocation. That's why every time you get a dip, there's no follow through. There's that big institutional buying under the market every time. The only thing to change that would be a major geopolitical scare or, something more dramatic out of Washington. So, I think we're back into gridlock in Washington for the foreseeable future until we see proof of otherwise. So that sets up for a no-way market. You can make a lot of money on a no-way market, by doing straddles, iron condors, outright shorts of puts and calls, and running fully hedged portfolios, which is what we're doing now.
All right. Thanks. That was a reasonable explanation.
Yeah, there's a great chart of a flat market someone just put up there, too. I guess that was you, Larry.
I'm sharing a 60-minute chart of the S&P 500 right now. So
that has VIX 8%, $8 written all over it.
All right, so I said down. I'm 65% down this week. I like the E-mini 60-minute chart in terms of where we're a direction for the week. And what I'm showing here on my chart is, again, a 60-minute look at the ES. And I use a combination of Elliott wave and Ichimoku cloud. I call it East meets West. And I throw a little Dow in for a good measure, a little Dow theory. So what we've had since early February is a pretty impressive impulsive wave running up in the ES. And I've drawn some Fibonacci retracement lines. And so we've got a retracement zone that's taken us, if this plays out, it's going to take us down to 2334 to 2296. And what we can see on the S&P E-mini here on the 60-minute chart is pretty clear evidence of some lower lows, lower highs, lower lows after putting in a top. It's not putting in new highs. We see a momentum indicator turning negative, and we see price breaking down underneath the Ichimoku cloud, which is projecting support and resistance. So it's broken through support. We've got clear lower lows, lower highs, lower lows, lower highs. So I see downward momentum in a retracement from that last impulsive move over the last several weeks. So that's why I believe we have a, we're heading a little bit lower. Also, it's a little bit tough to predict. I'd have a higher confidence rating just based on the technical indicators I'm looking at here. But this week, we have absolutely very little planned economic news coming out, nothing really market moving. I don't think there'll be any surprises. We got housing later in the week and unemployment. We got Fed heads on the microphone all week, Janet later in the week. And to John's comment earlier, I think, a tweet or a press briefing does not make legislation. And so there's an awful lot of expectation built into the current market price around what the administration is going to do. But there's a 600 or 700 other members of another branch of government that have to agree and actually have to enact legislation. and that's, tax cuts and infrastructure spending and all that stuff takes a long time to implement and for the effects of that to be felt in the economy. So, but I think that sentiment may run out of legs in the near term, and some reality may set in.
Trump is only just finding out that 90% of what he proposed is either illegal or impossible.
I also saw a report that the amount of money moving into index ETFs is off the chart. For the first 2 months of the year, it's like 10x what it has been for the last several years.
For what kind of ETFs?
Tons of index
yeah.
ETFs. So you SPY, your QQQ, those kind of things. 10x the amount of money moving into those as normal in the first 2 months of the year.
Well, that's the end of a 10-year trend out of active into passive. This is the very end of it, because the active managers are going to start outperforming.
Yes, and that is historically the sign of the end of a bubble.
Absolutely, that's perfect.
All the money on the sideline, all the money on the sideline starts coming in, feeling like they missed it, and they're going to get burned again. I think we got a pretty good correction coming. The evidence isn't in for it to begin yet, but I think we got another. We're 8 years into this bull market, just normal cyclical market moves. We will get a correction. Don't know if it's this week, next month, but on the horizon, there's a good correction coming for us, and it's healthy, it's normal, and I'm kind of looking forward to it because we can make a lot of money. Market takes the stairs up and the elevator down. We can make a ton of money when it's dropping.
Hey, Dean, I think Neil's in now.
Oh, great. So let me stop this and figure out how to get back to here. Okay. So, hey, great that you showed up, Neil. Can you hear us? Can we hear you?
Yeah, everything's fine. Just had a little bit of trouble logging in there with the Gmail address that I don't use very often. So created another one, and now I'm in.
Circle back because we want to hear from you. So why don't you start, Neil, of you and the service you offer, and just a quick intro.
Yeah, sure. I run a site called TraderReview.com. It's a stocks and options service where I send out my picks. I used to be a broker a long time ago now, 98, 99, just before the tech boom, during the internet boom. And in our training, they told us that you are not financial advisors, you're financial counselors. And that was when I decided my time was going to run out of the office pretty quick, because all I was interested in was making stock picks, not just gathering assets, which is what they like you to do. So I learned point and figure charting back then, was my introduction to it, which was fantastic. Been doing that ever since. I think it's an incredible methodology. Now I use Ichimoku Cloud as well for fine-tuning entry and exit points, and had a lot of great success timing market ups and downs and sector rotation. So that's what I do.
All right, another Ichimoku Cloud guy. I'm standing on.
Yeah, I saw no one with the cloud. I was going to say I'm the only one allowed to use the cloud around here.
Well, I logged in first, man. You got to turn it off on your chart.
Mine's a different color.
Yeah, no problem. Yeah, I sometimes say I'm standing on the shoulders of three giants, and that's Charles Dow, Ralph Nelson Elliott, and Koichi Asada, who wrote Ichimoku Cloud. I use them all together, and I like the East meets West, and they're two completely independent systems, but when Elliott Wave and Ichimoku agree, that's pretty cool stuff, right? So I like the cloud a lot.
It's nice when they all come together.
Yeah. So Neil, what's your prediction for the market, the S&P 500, from Monday's open till Friday's close, up or down, and what's your confidence on that?
Probably going to go down. The market's been hanging around sideways too long, some fake breakouts, and the RSI on the weekly came down from 70, which almost, you hardly ever get an RSI above 70 on the weekly on S&P 500, and confidence about 60-65%. But what I think is probably going to happen is a lot of sideways motion, and I think good chance of a sell-off on Friday. Nothing huge, but I don't expect any upside really.
So for the other panelists, we got one up, one down, and one flat, and all the up and down are at 65% as well. So kind of a mixed bag, but I think most people are looking not for a major move, but some kind of sideways, and the up and down may be just in the noise, right? So what's your, if you want to expand on your reasons for that, Neil, if you want to share a chart or something, this would be a great time. I'd love to hear you
Sure.
defend your prediction a little bit.
You can see this now?
Yeah, I think so.
Okay, so this is my main indicator, S&P 500 bullish percent index. It says scale of 0 to 100, what percent of stocks in the S&P 500 are on a near-term buy signal? And so it's just below 78% here. So unless this reverses into O's, it's basically cannot happen for a big reversal to happen with this not going into O's with enough stocks falling on a sell signal. So I never go full bear unless this goes into O's. But I was also looking at, let's look at Ichimoku Cloud here. I'm just going to bring up SPX. This is a really awesome site called TradingView.com. And I mean, we're still above the daily cloud here on TradingView, but I'm going to go down to a 15-minute view. Just a second. Okay, so S&P 500 broke the 15-minute cloud here. Peak was back here. And if you see anything like this in your intraday trading, with this candle here, basically an inverse hammer, and the RSI way up here, I mean, that's a time where you got to get out of a short-term position. I mean, no doubt about it. But below this 15-minute cloud, unless it gets back up above the 15-minute cloud, I think we can just hold it down here for a short-term move down or just some consolidation.
All right, great. That's a pretty cool looking site too. Thanks for sharing that.
Yeah, you got to sign up for
on.
Got it. Pretty much free. Even what you can do, very cool. Just a quick thing here. You can actually put point and figure on top of the Ichimoku Cloud, which is very neat. Very, very cool things you can do on this site here.
Very nice. Very nice. I'm not sure if you were on, but I was showing a 60-minute chart of the E-mini, and it's down below the cloud on the 60-minute chart right now. That's part of the basis for my prediction for
I was showing the 15. Yeah, this is the 60. But you've got this.
Yeah, so that's the cash. That's the cash. I'm looking at the overnight market on a 60-minute futures contract.
Okay. I got to try to bring up these tickers because I don't know. I don't think you can get that on here.
Yeah.
No.
Yeah. So I showed that earlier. Yeah. So the 60-minute futures contract, 24-hour is down below the cloud. So I think that's key. That's key. So we're going to keep moving through the questions here. I like this next. This is David has those standard 3 questions we ask about the market direction, your confidence, and your reasoning. But then the 4th question is always something different each week. And so the 4th question is, what indicator influences your trading the most? And I thought the answers that the survey respondents gave were great. There were lot of diversity, a lot of people using MACD, moving averages, RSI. But for our panel, why don't we go ahead and have you guys walk through. So the question is, what indicator influences your trading the most? And we'll just stick with our order, and we'll start with you, Larry, on what indicator influences your trading the most.
Yeah, the main thing for me is I look at a lot of momentum type based indicators because you need, price momentum to push price higher or lower. And without that, you pretty much get stagnated. So, right now, the thing I was kind of focused on this week when trying to figure out where we're going to be is kind of looking at the NASDAQ. It's been the kind of the leader. It's been holding up quite strong. So based on momentum from that, it's still holding, above a key support area, this 5,400. And then the thing though that kind of goes against the grain is you can look at the S&P and it's barely holding on. I like to look at the moving averages as well. So it's just kind of sitting here on this 8 exponential moving average, just kind of barely hanging on like a thread ready to break. So, it could break and hit on down, but if the NASDAQ can hold here, and we've got what we call kind of a consolidation where it could break higher based on some of these other big, NASDAQ stocks. If we get a little bit of push from, say, Amazon breaking out to new highs, Nvidia started to pick back up. If Google could come back in, we could get a little bit push higher, which could support, the S&P, and the Dow is just kind of hanging here as well. Now, the thing I'll be looking at from a kind of a research fundamental standpoint is oil inventories on Wednesday. So to me, that'll be really kind of key. If we get a draw on crude, we'll probably get a little bit more, short covering or a little bit more stabilization on crude just going into the end of the week. And that could also help to, support the S&P a little bit more. If we get a big build on crude, then I'm looking for, this probably to break to the downside. So kind of those are the things I'm looking at. The NASDAQ being very supportive to the market right now, if it can hold this 5,400, and then looking for crude inventories on Wednesday to see exactly what those do, because we've had a huge pop on the crude bubble, last week, and it made it low down to 47, bounced off that. That was a 618 retracement key support level. So this week, if you can get some kind of draw, which we'll see, supposedly OPEC's, a lot of the offshore, the barrels that have been stored in tankers and stuff, a lot of those have made it into the, U.S., been taken off. So if you do get a surprise draw on crude, that could be supportive. But if not, then we could see this thing unravel a little bit more. So,
Larry, I have a question for you. It's John Thomas. Has anyone in the oil industry figured out that deregulation of the industry could lead to a complete collapse in oil prices once again?
Well, I agree with you. I mean, when you look at the shell and the all the U.S. producers, I mean, the technology just keeps increasing. The price, the break-even points keep getting lower and lower. And
right, every week those rig counts start to hurt more and more. I mean, it's been going up for almost a year now.
So that counteracts any production cuts from OPEC, and I don't think, besides Saudi Arabia, the other guys will end up cheating. That's what they always do, and they always will. Right. So they're behind the curve. So I don't see any positive outcome as far as crude going back up. I think that my view is that crude is going to, sell off. But right now we had that huge drop last week to 47. I think if you do get a surprise draw, we might see a little bit of a pop back, But I would be not aggressive, bull on the crude front. That is for sure, because these OPECers never do what they say they're going to do. It's almost impossible when you have all those various countries politically. They can't, they're going to cheat. And Russia.
Yeah, so you would sell into the next pop in oil prices, in other words.
Pardon me?
You'd sell into the next rally in oil.
Oh yeah.
I've been watching that really close, and I'm bearish on oil as well.
So let's take a look at a chart real quick. I can pull it up. I'll just kind of show you my view of it. You did have a kind of a floor and a ceiling with, I think OPEC's in a big problem area. I don't think that they can sustain their cuts. And I think that you're going to see, if you just look at where we came from, we had a lid over the market, huge, up here at $57, $60. That was just way too much to get through. And that's also all the domestic producers, man, they could just sell forward 2 years out at 55, $58, locking in as much, as they wanted, and then refinance or finance their production based on that. And so you saw last week we came down here and hit this 618 retracement level here and popped. And I think that, you've got the lid on the markets right here, probably about 51 right here, where these moving averages come in on the weekly. And, you've got 47, I think 47, and the next level will be down to 45. And I think then eventually back down to 42. So we'll see.
Yeah, the fact that Saudi Arabia is trying to sell off Aramco tells the whole story, doesn't it?
Exactly, and they're trying to prop the market up. And there's a lot of stories out about them getting the big hedge funds in to act, and they had a lot of different meetings with companies like Vitol, some of these other big, huge oil hedge funds, to tell them, hey, we're going to cut production, blah, blah, blah. So you guys maybe support us. So they were the ones that were long these massive amounts of futures contracts, I believe, where we had 2 weeks ago when we had the largest amount of oil contracts and futures contracts long ever reported.
Yeah, right.
Got popped last week. So, you know, the OPEC guys are just trying to set up, like you said, for that Aramco for their, you know, sell-off, but I don't think they're going to.
Window dressing, it's called.
Yeah, window dressing, exactly.
Who's an expert on oil contango here?
I am.
Contango? Yeah,
What do you
here's
wanna know?
contango.
What's happening with that right now?
Well, it's going to go lower. Here's contango right here.
Yeah, this will be good.
Pull it
Can
up.
you go over contango a little bit?
Yeah, sure. Yeah, so basically what contango is, here's a chart. This is April crude minus September. But basically what the markets look at for pricing, the curve is, like you said, the price curve is contango. So if we pull up, let me see, I'll pull up crude, I'll pull up the May contract 2017 minus May 2018. So here's the forward curve for 1 year. So let me see if that's right. Yeah, this is May. So basically you can see that, you know, it got as low as $1.50 under, but, you know, basically what you're going to see is that what OPEC wants to see is the production being cut back. And if that happens, then they're going to see the front end of the market move up and this contango will narrow. So when you have contango, the front end of the market's getting deeper and deeper discounted versus the back end. And that's because, you know, everybody's not needing the front end of the market. There's plenty of barrels to go around, so that gets sold down, but they're not selling off the back end. So when you get severe contango, the front end gets really, really sold down hard. So what happened back in 2014, 15, you had contango, basically the front end got as low as probably $15 below. And that's when you see the big oil companies come in chartering all these tankers, loading up the tankers with the discounted oil, then they hedge it forward to lock it in, and then the spreads come back in, they can sell, you know, start rolling back out.
Yeah,
So
in the 09 crash, it got down to about 10% discount.
Yeah. So that's what the big play is. And so, like, for example, Vitol, I read that they had a 300,000 deadweight ton ship that they loaded up. That was just one of them. They had so many ships out there that they were loading up with crude. And so basically it pulls all the weak barrels off the market. They store it for a year or whatever, and it comes back. That's the kind of the play on contango.
Yeah. Interesting.
All right, that is really, really interesting stuff. And we started with an indicator discussion, but it was good. It was good.
Well, there's reasons why indicators indicate, and that's because stuff is happening behind them. You know, that oil tanker trade at the best price, that was 100% year-on-year profit, no risk.
Exactly. If you're big enough to do it.
Every investment bank on Wall Street was in this one in 09 and 10.
Yeah. So it's
Neil,
a big play. That's the big money.
I'm going to move it forward to Neil here. What indicator influences your trading the most, Neil? And if you want to share a chart with that indicator, that would be.
Yep. I think I got to click the screen share button. Okay, yeah, I showed it before. This is like my main indicator, bullish percent index. You can also use this for different sectors. But what I like to use for commodities is Ichimoku Cloud. And so I just brought this up because we were talking about oil, and I was warning actually at $52 on oil. And if you look here, something trading below the cloud here, this is 15 minutes. Every commodity or currency, well, not currencies, but every commodity will have sort of a different one that works the best, like a 15 or a 5. And so on this one, you got a bounce up here to the cloud, and then this sell-off here, and then just a complete huge move down here. Just the cloud again, boom, another move down. And the more times you try to trade the same strategy, the less it's going to work. So you normally go for 2-3 bounces. And if you just keep looking here, bounce up to the cloud, move down. And so Ichimoku Cloud is really one that I like for commodities, and especially for currencies. I use it for currencies all the time.
Cool. Yeah, I use Ichimoku Cloud as well, and you can see on your chart, you know, it does project support and resistance pretty nicely. You can see when we break the cloud, it's where the cloud is, right? Where it's projecting the lowest support or resistance. So it is a cool.
here's an hour chart I'm just bringing up here on oil. So this is 52 right here on the breakdown. And you kind of got those three moves, 1, 2, 3. And then check out here, Cloud Touch, another move down. But that was shaking out all the people that were scared down here. And then you got sort of in no man's land now. When a cloud goes sideways, you're pretty much in no man's land, I think. So
Right,
Yeah.
exactly.
All right, so Mad Hedge Fund John, what's your
Well,
what
it's
indicator-
John, and I'm the mad hedge fund trader. How do I drag a chart onto this window? Is David there?
you click that little thing up on the left that says screen share, and then you pick a application or a window you want to share.
Little thing up on the left.
Yeah, on the left side of the screen, a menu will pop up if you move your cursor over there, and there's a green screen share button.
What does it look like?
It has a little arrow on it.
Q&A, webinar jam chat, a screen share. Okay. Screen share Hangouts. I'll just pick one. Start screen share. Okay, I got it. Okay. What do I do next? You are screen sharing, it says. So where do I put it?
Yeah, you're showing your screen now, so just pull up the chart you want, and we should be able to see it.
Yeah, I'm dragging it, but it's not staying there. Do you know where I drag it to?
Do you have multiple monitors?
I do.
Or, okay, so it looks like it's sharing.
What do you see up there?
I'm
I'm trying to drag the CNN Fear and Greed Index up there.
Yeah, we're seeing the window. So whichever screen that. Okay, now.
Yeah, I can't get the image up there. Anyway, let's just go back to video. If you're looking for a really easy one-stop indicator that you can follow real time, which is free, I would go with the CNN Fear and Greed Index. It's a compilation of about 20 different indicators that CNN compiles real time. And I found it incredibly accurate over time. When it shows extreme greed or a low number, that's a great time to buy markets. When it shows sell markets. When it shows extreme fear, that is a great time to buy markets. And right now, it's showing at an index of 44 on a scale of 1 to 100. 50 is neutral, so we're just slightly on the fear side of neutral. So one-stop catch-all indicator, real time, that's where you go. It's easy to follow.
All right, I look at that one once in a while too. It's pretty fun.
It is. They've been doing it for about 3 years now.
Yeah. All right. So I'm Dean Jenkins, and in terms of my indicator, the question is, what indicator influences your trading the most? And for me, there's no one. There's no one indicator. The thing that matters the most to me is price. Price is the only reality in the market. Price and volume. Everything else is a projection. Most indicators are a wonderful look back in the rearview mirror. I like Ichimoku Cloud that it does project support and resistance areas, but I look at price movement, and I use Dow theory, and I use Elliott wave, because I think Elliott wave, you can analyze price movement. After an impulsive move, there's a high probability of time that price is going to correct at least 2 Fibonacci levels, and then if you get evidence, it's going to move another impulsive move in the original direction. So I study price the most. There's no one indicator that I could not live without. I use Ichimoku Cloud. I use some momentum indicators to help me, but I like them. They give me an edge, but there's no one indicator that I could not live without. Price movement, I could trade with nothing more than price movement and Fibonacci retracement and extensions. And those aren't indicators, those are analysis tools. But I like having some there, but that's my riff on indicators. I think they're helpful, but I don't rely on any one. I look at a combination of them to make sense of price patterns. All right. So at this point, we'll go back down the list. We'll just keep that order of Larry, Neil, John. And at this point, is there a particular trade you're looking at you'd like to share with the audience? You know, a trade you're looking at that you like, that you would recommend or at least share with the viewers. So we'll start with Larry. What do you like, Larry? What's a trade you're in or teeing up here?
One of the more kind of easier neutral type trades is just to, you know, do what John was talking about earlier. We did bear call credit spreads. So like Friday, set up bear call credit spreads on the SPX, the CBOE, cash, S&P. So what I like to do when we see this, you know, again, kind of what I call price momentum divergence. If I pull up SPX, I like to sell out of the money bear call credit spreads. So I like to try to get, you know, like close to like a 1 standard deviation out of the money to have the short strike short. And so, you know, that was basically on Friday able to sell up here about 24.15. So we sold the 24.15, 24.20 bear call credit spread on SPX. You could do that on SPY as well. SPX is just like if you do one contract SPX, that's like equivalent to 10 on SPY. So what this does is that even if the market was to churn and go sideways, we're looking for maybe the market goes sideways to potentially sell off, then, you know, it's going to benefit. And if it just goes sideways to even up a little bit, it'll still benefit taking advantage of time decay theta. So by selling out of the money, you know, and if it churns sideways, we just collect premium and take advantage of that time decay theta. So that's what I like. So if you could get something out of the money, I like to usually shoot for like $100 on a $5 wide spread. It gives you, you know, potentially 25% return. So I had to go out to like an April, I think it was the April 14 series. So you have to go out about 20 days or so. But if it starts churning sideways, that theta decay starts kicking in fast. So I like that.
Okay. Very good. Neil, what do you like right now? What are you in, or what are you teeing up there?
Could you get back to me in just after the next person? I'm just looking up something real quick.
Okay. John.
Yeah, you know, like I said, we're positioned for a flat market, so we are running a market neutral portfolio. We are long S&P 500 in the money call spreads, long Goldman Sachs call spreads. We are long Treasury bond or TLT call spreads, the bet that interest rates go down, and we are long S&P 500 put spread. So market neutral, low risk. We're only using about 40% of our portfolio right now, 60% cash, and it's a bet that the market doesn't go up or down more than 2% in the next couple of weeks. And if that works, we'll make a 10% profit on the entire portfolio, basically for, you know, 2.5%, for 25% profits on 4 positions. So that is how we are positioned now. You know, looking to get back into NVIDIA on the next dip, and looking to sell Treasury bonds short on the next rally. Those would be our 2 upfront trades. Just took profits on NVIDIA, by the way. We got in at 96, came out Friday at 106.
Nice.
Yeah, we did the NVIDIA last week too. I like that one. That was a really great setup last week. It was down on some great support at 95, so it was perfect. And we did a nice wide wing butterfly, real low risk, and took it off Friday as well at 105.
Yeah, I should say that NVIDIA is probably one stock where you do want to take on risk, but just owning the stock outright or owning calls outright, we expect that stock to double between now and sometime in 2018. They basically own the artificial intelligence industry right now.
All right. I should be sharing now. I've got a chart up, BABA. This is Alibaba. So we're long Alibaba, and we like this one. We think there's some room left in it here. This is an Elliott Wave 5 trade. So we got an initial 3 up, a beautiful, perfect 4 down, clear evidence of Wave 5 starting. Got a target zone between 117, 136. We're up above the cloud. We got positive momentum. We've got our current stop trailed up to 102.09. So with this stop and this target, there's still plenty of risk to reward left in this trade. And this one trades really, really deep, high volume, and there's a great option market. So this is a great one just to grab, about like an August contract and just go long the calls on this one. And I would just go delta and hold on to that thing for about 3 months, 4 months up into the target zone. So that's one we're in. We're long VABA right now and still like it, still room left in that trade. We got short on American Airlines last week. Pretty fast trade, about a week and a half. Got short 45.39 and took it right down to our target in about a week and a half. And that was a really, really nice move. It may continue down some more, but kind of late to get into that one. Show one more that I like, and this is AWK American Water. So this is it has a nice wave 3 up, a good wave 4 that channeled, and we broke out of that channel, and it looks like it's heading up to a really, really nice target up above $90. So another one. It's not quite the volume of BABA, but there is a decent option market out there, and you can go out to no sooner than June and just go long the calls on that one. Again, deep in the money, high delta, and probably do pretty well on that. We like that chart. We like that trade. All right, so we're getting close to the end, and this is where we go back around one more time, and just if there's any final closing thoughts that any of the panelists have. Or anything, just a final final statement about your site. If there's a link you wanted to show on a screen or whatever, this would be a great time for that. So, Larry, go ahead and close it up for power cycle trading.
Yeah. So basically, just kind of a summary. To me, not trading like the indexes. I think that there's a little bit more risk that they're going to turn sideways to pull back a little bit potentially, but be in your trading, be more stock specific, so I liked all those stocks that you mentioned. Actually, those are some that we're, watching as well, and like Alibaba, BABA, NVIDIA. I think NVIDIA's running into some resistance here at 110, but I like that one. Amazon potentially for a break, it's kind of consolidating, so it could potentially break higher, or it could pull back too, but be stock specific with what you're trading versus trying to trade the indexes right now, because they're struggling. They've had the big push up and they're churning, and they're churning. With that churning activity, if you're trying to trade indexes, you're going to usually just be frustrated and probably waste money if you're buying options. So look for those that are stock specific, and a few of those were pointed out earlier here today. Alibaba is a good one. That AWK looked good. NVIDIA, if you get a pullback, things like that. So that's what I would be, looking for going forward for the rest of this week.
Yeah, I really like your comment about individual stocks. There are sectors and stocks that are just doing great. I think the index. I agree. The indexes are tough to trade right now, unless you're a sideways neutral kind of trader. Now,
one more thing, the retail stocks look like some potentially good shorts too. So you might, you look at Lulu, look at, Coors, KSS. I mean, those suckers are coming down to key support, and if they break, you could get a good flush to the downside. So if you're looking for shorts, look to some of the retail stocks.
Yeah, if we go ahead with the border adjustment tax, you can basically write off the entire retail industry.
Yeah.
They lose their entire profit margin if that happens.
Yeah.
All right. We're going to keep going here, Neil. So thanks, Larry, for your comments there. And Neil, if you have any closing comments and website or link you'd like to share, let her rip.
Yeah, I mean, it's like everyone was saying, now is really, I think, a time to go for the income if you can. Making a running play instead of a passing play. The market's always like that. That sort of dictates to you what you have to do, and then you adapt. And keep an eye on that bullish percent. You can go to stockcharts.com, just type in bullish percent, and a lot of different bullish percents will come up. And when those reverse into O's, market usually goes down for at least a couple days to look to do some shorts, get out of some positions, raise your stops, that sort of thing. So that bullish percent really helps quite a lot.
All right. John, last words.
Yeah, this is not a great market right now. Your position should be low. This is not a bet the ranch market. The market doesn't care if you need money or not. It's just not a good time to trade. Keep your powder dry for better times. And if you want to make 38% a year, you can go to our website, get some free research, follow our trade alert service at madhedgefundtrader.com. And if you want to make more money than that, you can go with the other guys on this panel.
All right. Thanks, John. So my closing words, I do think it's a difficult market. I'm staying away from the indexes. I think there's individual stocks. I also, I'm looking for a move up in gold. It looks like it may be giving us something here really soon, and I'm bearish on oil as well. My website, followmetrades.com. If you go to the website, you can sign up for a free newsletter, and that's a great way to get started. I give a weekly commentary on the market with key price levels we're watching. And my track record is there on the website year after year. There's a grid, and I show what each year's portfolio return is, and you can drill down and see every single trade we've taken, and those are verified trades. They've been confirmed. What we're showing is what we're doing. So I'd love to have you check it out. Followmetrades.com. Well, good show. I appreciated the comments and each of the participants. Pretty interesting stuff, and glad I was able to be here. Thank you. And David, I think we're a wrap. It's back to you.
Yeah, great show. Thanks, everyone. I just want to remind everyone watching, be sure to hit the YouTube subscribe button if you haven't yet to get updates on future shows. Also, you can go to TimingResearch.com and download any of the past reports or watch any of the past shows there. I've also been posting a audio, podcast version of the show each week recently, so you can download that and listen to it in your car or gym or whatever. Be sure to join us next week. Anka Metcalf, Jim Kenny, and Matt Buckley will be on. And just want to thank my guest again for this week, Larry Gaines of PowerCycleTrading.com, Neil Batho of TraderReview.com, John Thomas of MadHedgeFundTrader.com, and Dean Jenkins of FollowMeTrades.com. Thanks, everyone.
Okay, take care.
Thank you, David.
All right. Thank you.